Hey, welcome back. It's Nolan Mathias from Mortgage 360, and today we're discussing the Bank of Canada's surprise rate announcement and what economists did not expect and what it means for you with respect to your mortgage going forward. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where when we hit 10,000 subscribers, we are going to make a monthly rent or mortgage payment for one lucky subscriber. All you have to do is click that subscribe button. It's free, it's easy, and it's definitely worth it. So let's get into it. Roll that intro. The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so today's Bank of Canada meeting, or their announcement, was an interesting one because economists were largely unanimous in their prediction that the Bank of Canada would leave its overnight lending rate at 0.25%, which they did. However, most economists expected that they would start to taper back their bond purchasing program and their treasury purchasing program, ultimately as a result of the recovery and ultimately leading to higher bond prices eventually, and therefore less money flowing into the economy in an effort to basically reduce inflation. And the surprise was that that didn't happen. Tiff Macklem and the Bank of Canada basically said that they have no plans to slow down their asset purchases as a result of the fact that unemployment is still quite high. And that is really, really interesting because what they're saying is that they aren't just focused on inflation when it comes to interest rates and their policies and procedures, but they're also focused on jobs and what's happening in the job market. And I mean, let's take a look at unemployment right now, because if you go ahead and you take a look at the unemployment rates, I'll show you my screen here. This is just Googling Canada unemployment rate. The unemployment rate is at 9.4%, which is the highest rate that it's been since August 2020, which was pre-vaccine announcement. So, keep this in mind that unemployment is still really high, and the Bank of Canada is very much taking a look at that, and they are very, very, very much considering that when it comes to their interest rate and their asset purchasing policies. So there's been a lot of talk about inflation. There's been a lot of talk about the fact that interest rates are going to have to go up because of inflation, and it seems like the original promises of it taking until 2023 until interest rates start to go up is going to continue to be the promise that the Bank of Canada is making. At this point, they're saying that they're still on track with their asset purchases and that they don't expect to stop doing those, because if they did, it would have a pretty adverse effect on the economy. And let me tell you how. Because here's the thing, if they stopped doing their asset purchases or indicated that they were going to stop doing their asset purchases, that would lead to a stronger dollar. I mean, today, just the surprise that this happened, and I'll show you my screen again. Today, just the surprise that they didn't stop their asset purchasing, it basically led the Canadian dollar to decline by 0.2%, which, I mean, can you imagine if they had said we're tapering off asset purchases, the Canadian dollar would have increased in value compared to the American dollar. And what happens with an increasing dollar compared to the American dollar is it makes our exports more expensive. So what we don't want is as the American economy is getting better, we don't want the Canadian dollar to get more expensive and make our exports more expensive and have the Americans going and purchasing products and purchasing things that they're importing, like natural resources, from other places. So you have to think Tiff Macklem and the Bank of Canada have a vested interest in keeping our dollar as low as possible so that when economies do start to pick up, our export economy starts to pick up, and therefore the GDP and all of the good things associated with the Canadian economy at that time will kick into effect. Now, here's the interesting things. If I go back to my screen here again, if I take a look at this morning's headlines, this was before the decision at 10 a.m. Eastern time. Very much the headline was investors are bracing for the Bank of Canada to taper as decisions loom. This would have meant that bond market yields would have gone up, which would have meant that the interest rates, the fixed interest rates in Canada would go up again. In fact, what happened was yesterday, interest rates started to go up, fixed rates started to go up slightly again, under the expectation that the Bank of Canada was going to start tapering their asset purchases. My guess is because of this decision, we are going to see those fixed rates come down slightly, not a ton, but slightly as a result. So what that means is fixed rates are probably going to get a little bit cheaper again, which is a good thing. And that's a large part of why Tiff Macklem isn't reducing asset purchases, is because the fixed rates are getting higher, which means, yes, fixed rate mortgages are getting higher. And that as a result could potentially reduce the demand for housing. But more importantly, it could reduce the demand for other types of borrowing, especially in the commercial sectors, which could have a negative effect on the economy. So this is very strategic what they have done. And if you go and you take a look here and you look at what they have said is that they have the expectation that there's going to be a rise in the CPI inflation rates, and they expect that because of the deep declines in prices last year. And as the base months for the CPI start to flow through, so March, April, May, when things obviously got significantly cheaper, what you're going to see is that inflation is going to rise because compared to last year, obviously things with the economy being better right now are going to be priced higher. But then what he expects is that as the months go forward and as we get into July, August, where we had more normal months, that inflation rate is going to come back down. So this is why he's saying that we're still going to see a very long, or at least until 2023 with low interest rates. So what does this all mean for you if you are a home purchaser? Well, what it means is that yes, fixed rates did go up, but variable rates are an incredibly good value right now. And if you're getting 0.5% to 0.75% better on a variable rate, you're basically banking $750 for every $100,000 in mortgage that you have for the next 2 years, at least until 2023. And yes, while inflation is a concern, employment is also a concern, and it's going to take a long time for employment to get back to where it was pre-pandemic. And you can pretty much expect that even with a large amount of money injected into the economy because of high unemployment, you aren't going to see high amounts of inflation, because when you've got that many people who aren't working, it means that it's really, really hard for prices of everyday goods to go up substantially. Because obviously, if there's no demand because people aren't working, and if they aren't working, they aren't buying things, well, then inflation is pretty much going to have to stay where it is. Now, that's a very, very, very oversimplified explanation of this, but the reality of the story is that the Bank of Canada and the Federal Reserve Bank, more importantly in the States, have said unequivocally that they need to see a very, very, very long and sustained amount of time within the inflation band that they expect to be in before they're going to do anything with respect to increasing interest rates. So that's why variable is such a good deal right now. It is an incredibly, incredibly good value for mortgages. And the big thing and the big benefit is you have no penalty exposure if interest rates go back down and there's an opportunity to refinance, or you want to rejig things. Now, another option that came up in the last week or so is a 3-year mortgage, because in the past, these 3-year mortgages haven't been priced super, super aggressively, but a couple lenders are now pricing a 3-year fixed at 1.54%, which if you're the type of borrower who is worried about a variable rate, it could be a very, very, very good option for you, because you know at least for the next 3 years exactly where your interest rate is going to stand. So the big news today was the fact that the Bank of Canada isn't going to decrease its asset purchases, and they are very, very strategically signaling to the market that they are going to continue to do what they need to do in order to make sure that the economy is able to get back to where it was pre-pandemic, which means variable rates and prime rate are going to stay low at least for the next couple of years. You can pretty much bank on that, at least according to the Bank of Canada. And at the end of the day, if you aren't a variable rate borrower, that 3-year fixed is very, very attractive. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about a race to 10,000 subscribers, where you could win your monthly renter mortgage payment for a month. All you have to do is hit that subscribe button. I certainly hope that you did it. Cheers, we'll see you on the next video.